Warren Buffett was born in 1930 in Omaha, Nebraska, during the Great Depression. While most families struggled financially, Buffett grew up surrounded by conversations about money and economics. His father was a stockbroker and later a congressman, exposing young Warren early to financial thinking. This environment shaped his curiosity for numbers, discipline, and long-term thinking from a very young age. Unlike most children, Warren Buffett did not see money as something to spend, but as something to grow. He carefully observed how adults earned, saved, and invested capital. Even at a young age, he understood that money could work for you if managed correctly. This mindset would later become the foundation of his legendary investment philosophy. Warren Buffett showed an unusual obsession with numbers during childhood. He memorized stock prices, baseball statistics, and company earnings purely for fun. Numbers were not abstract to him. They told stories about performance and value. This ability to process numerical information quickly gave him a massive advantage when evaluating businesses later in life. Instead of toys, Buffett preferred calculators and financial tables. He enjoyed comparing figures and identifying patterns others ignored. This analytical mindset allowed him to detach emotion from decision-making. While others guessed or followed trends, Buffett relied on logic and math, reinforcing a discipline that would define his investing career for decades. Before turning 10, Warren Buffett was already running small businesses. He sold chewing gum, Coca-Cola bottles, and magazines door to door. These ventures were not about profit alone. He tracked costs, margins, and scalability. Buffett treated each activity as a real business experiment, learning lessons that most entrepreneurs don't grasp until adulthood. One of his earliest successes was delivering newspapers. He built multiple routes and reinvested profits efficiently. By age 14, Buffett had accumulated over $5,000, an extraordinary amount at the time. These early ventures reinforced his belief that consistent effort and smart reinvestment compound over time. Warren Buffett's life changed when he discovered Benjamin Graham's book, The Intelligent Investor. Graham introduced the concept of intrinsic value and margin of safety. Buffett immediately embraced this framework, realizing investing was not speculation, but disciplined analysis. Graham later became Buffett's mentor, deeply shaping his financial philosophy. Under Graham's guidance, Buffett learned to buy businesses at a discount to their true value. This method reduced risk while increasing upside potential. The principle of protecting capital before seeking returns became central to Buffett's strategy and separated him from most market participants focused on short-term gains. Warren Buffett refined value investing by focusing not only on cheap stocks, but on high-quality businesses. He realized that buying an excellent company at a fair price often outperformed buying a mediocre one cheaply. This evolution marked a crucial shift that fueled his long-term success. This philosophy emphasized durable competitive advantages, strong management, and predictable cash flows. Buffett ignored market noise and focused on fundamentals. By combining patience with deep analysis, he built a repeatable system that consistently generated wealth over decades, proving simplicity can outperform complexity. One of Warren Buffett's earliest investment mistakes was buying shares of a struggling textile company called Berkshire Hathaway. Initially, he saw it as a classic undervalued stock opportunity. However, the business fundamentals were weak. This experience taught Buffett a crucial lesson. A cheap price alone cannot fix a bad business model. Buffett later admitted that this decision cost him billions in opportunity cost. If he had invested that capital elsewhere, the returns could have been significantly higher. This failure reshaped his strategy, pushing him toward exceptional companies rather than statistically cheap ones. Instead of abandoning Berkshire Hathaway, Warren Buffett made a radical decision, transform it into an investment holding company. He redirected cash flows into insurance, consumer goods, and financial assets. This pivot turned a dying textile firm into one of the most powerful conglomerates in history. Insurance companies like Geico became key engines of growth. By generating massive investment capital known as float, Buffett used this money to acquire businesses and stocks with long-term potential, compounding returns at an extraordinary pace. In the late 1980s, Warren Buffett made one of his most famous investments, Coca-Cola. He recognized the brand's global dominance, pricing power, and consistent demand. Buffett invested over $1 billion, a bold move that would generate tens of billions in long-term returns. This investment illustrated Buffett's belief in simple, understandable businesses with strong brands. Coca-Cola became a cornerstone of Berkshire's portfolio and demonstrated how patience and brand loyalty can create enormous shareholder value. Warren Buffett is famous for saying that his favorite holding period is forever. He avoids frequent trading and ignores market volatility. This discipline reduces costs and allows compound interest to work uninterrupted over decades. While others panic during market crashes, Buffett sees opportunity. His calm behavior during financial crises allowed him to buy quality assets at discounted prices, reinforcing the advantage of emotional control in investing. During the 2008 financial crisis, Warren Buffett deployed billions into companies like Goldman Sachs and General Electric. While markets collapsed, he negotiated favorable terms, securing high returns with limited downside risk. These investments solidified Buffett's reputation as a financial savior. His ability to act decisively during chaos proved that liquidity, patience, and credibility are powerful advantages when markets break down. Warren Buffett evaluates companies by focusing on fundamentals rather than market trends. He looks for consistent earnings, strong cash flow, low debt, and a durable competitive advantage. Buffett avoids complex businesses he cannot easily understand, believing that clarity reduces risk and increases long-term investment success. Management quality is another key factor. Buffett prefers companies led by honest, capable leaders who allocate capital wisely. He often studies annual reports and shareholder letters to evaluate decision-making, believing great management can significantly amplify shareholder value over time. Warren Buffett's strategy relies heavily on long-term ownership. He allows investments to compound for decades, letting time do most of the work. This approach minimizes taxes, reduces emotional decisions, and maximizes exponential growth through compound interest. Buffett often explains that small annual returns become massive over long periods. A steady 10% return over 50 years can transform modest capital into enormous wealth, proving that patience often beats brilliance in investing. Despite his success, Warren Buffett openly admits his mistakes. He missed early investments in companies like Amazon and Google, acknowledging that fear of overvaluation sometimes held him back from transformative opportunities. Buffett also regrets holding on to poor businesses for too long. These mistakes reinforced his belief that buying a wonderful company at a fair price is better than buying a fair company at a wonderful price. Despite his immense wealth, Warren Buffett lives a remarkably simple life. He still resides in the same house he bought in 1958 and avoids luxury spending, believing that happiness is not tied to material excess. This lifestyle reinforces his investment philosophy, discipline, restraint, and long-term thinking. Buffett believes that controlling personal habits strengthens financial decision-making and prevents destructive behavior driven by ego. Warren Buffett's partnership with Charlie Munger was fundamental to his success. Munger influenced Buffett to shift toward higher quality businesses, improving Berkshire Hathaway's long-term performance dramatically. Buffett also built trust-based relationships with executives and investors worldwide. His reputation for fairness and consistency allowed him access to exclusive deals unavailable to most market participants. Warren Buffett often says that compound interest is the most powerful force in finance. He began investing seriously at a very young age, allowing decades of uninterrupted growth. The majority of his net worth was generated after age 50, proving that time, not timing, is the true multiplier of wealth. Buffett explains that reinvesting profits consistently creates exponential growth. Even modest annual returns become massive when compounded over long periods, highlighting why patience and consistency outperform aggressive short-term strategies. Warren Buffett committed to donating over 99% of his wealth primarily through the Bill and Melinda Gates Foundation. His philosophy is that extreme wealth carries a moral responsibility to improve global health, education, and poverty reduction. Rather than building dynastic wealth, Buffett believes capital should return to society. His donations rank among the largest charitable contributions in history, reinforcing his belief that money is a tool, not a scoreboard. Warren Buffett places ethics at the center of business. He famously tells managers to protect the company's reputation above profits, stating that financial losses can be recovered, but trust once lost is nearly impossible to regain. This ethical stance attracted partners who valued transparency and integrity. Over time, it strengthened Berkshire Hathaway's brand, proving that long-term success is closely tied to credibility and moral consistency. Warren Buffett is widely regarded as the greatest investor of all time. His strategies reshaped modern investing, influencing millions of professionals and individuals worldwide. His annual shareholder letters are studied like financial textbooks. Beyond returns, Buffett's legacy lies in teaching discipline, rationality, and humility. He proved that consistency, ethics, and patience can outperform complexity in the financial markets. Warren Buffett's life proves that extraordinary results do not require extraordinary behavior. Simple principles, applied consistently over time, can create immense wealth and lasting impact. His story is a blueprint for sustainable success. More than money, Buffett mastered decision-making under uncertainty. His journey reminds us that patience, clarity, and integrity are not weaknesses, but powerful competitive advantages in business and in life.